I want to start off by asking you about your growth forecast. There's been a significant upgrade to your growth outlook.
Yeah.
You also have upgraded your inflation forecast, and you still cite upside risks to your inflation forecast in the future as well. It sounds to me like there is still more work to be done on the rate side. Can you elaborate?
Well, let me start with the rate side and then come back to the components of it, as you say. We've been very clear in the message today on rates that we're not giving a steer on future rates, and we didn't do that last time either. So we will in a sense be shaped and driven by the evidence as it emerges, and I just want to be very clear on that. We're not giving a steer one way or the other today. On growth, yes, we have upgraded our growth forecast. I mean, I would draw a distinction between change and levels here. I mean, change, yes, it's one. I think it's maybe the biggest upgrade we've ever done. The level is still quite low, though. I mean, let's be honest. Mm-hmm. The reasons for the upgrade: lower energy prices feeding through. That's very helpful. Fiscal policy, we've obviously incorporated the budget since we last did a forecast, and that is providing more support. And the global economy is providing more support. I think, China, for instance, I would point to there. The end of the zero COVID policy was less, I think, disruptive than many of us feared it might be. And I think fourth and finally, I would say the UK economy is more resilient. Employment has been more resilient than we feared and thought it would be, so that's good.
How much confidence should we actually have in these forecasts? Because it was not so long ago that the Bank of England were telling us that we were going to see 4 negative consecutive quarters of growth and a very long recession. None of that has panned out.
Well, can I start by making an important, quite fundamental point about forecasts, and certainly our forecasts. They are conditional forecasts. They're not unconditional, they're conditional. By that I mean they are conditional on financial market prices, they're conditional on commodity prices, they're conditional on government policies. So as those conditions change, we change our forecasts. So there has been a very big change in energy prices, for instance, since our last 2 forecasts. And that feeds through into the forecast. So the forecast does change in that sense, and it's appropriate that it changes. But I just want to emphasize that conditional point. The second thing is that we're living in a world of very big shocks. Those shocks were very hard to predict at the time. I would say impossible to predict. Sadly, I'm afraid the war in Ukraine is a terrible thing, and it was not possible to predict. I'm afraid that would happen in advance. We have to deal with the consequences of it, and understanding the consequences of it is hard to forecast. So we have to deal with all these things, which is why our forecasts do change and do evolve.
Well, you've kept the line about there still being upside risks to the inflation forecast. What would you need to see to be confident that inflation actually is beginning to move in the right direction? Well,
I think there's 2 parts to that. I mean, there's the sort of first half of the forecast and the second half of the forecast. So let me start with the first half. I think we do expect quite a rapid now fall in inflation during the rest of this year, going into next year. And obviously we want to see that happen. That's not so much what I would call a behavioural thing. Some elements of it are. It's more, are we going to see these things that we're told are going to happen, some of which are mathematical, so they will happen actually. These are base effects, the annual effects. But we just need to see this actually happen now. Then you go into the second half, which is much more judgmental and in a sense behavioural in terms of particularly the question of persistence. And what's going to happen. Are we going to see any output gap open up? We think we will, but it's going to happen later than we thought and probably less than we thought. So how are those things going to evolve? And those are always judgmental elements. And just to add, one of the things that we've spent most time on in this forecast is the whole question of what we tend to call asymmetry. So inflation went up very rapidly. I mean, we know why, in a sense. We can identify all the causes of it. If you let a model go to work, it tends to be quite symmetrical. It comes down very rapidly. And we suddenly said, no, sorry, hang on, this is where judgment comes in, and where other approaches, other sort of economic approaches come in. And we do think there are risks that it will be more asymmetric. It will come down, but it will take longer to come down.
Yeah, well, that comes back to persistent inflationary pressures. And I want to bring up the comments from the UK economist, chief UK economist Hugh Pill, who said that people need to accept that they're poor. Obviously, it's sloppy wording. We covered that in the press conference. But is this sentiment not correct, and that it would make your job easier if people just stopped asking for pay rises?
Well, let me just re-emphasize, and and Hugh would agree, Hugh and I have talked about this a lot, it's not the right choice of words. But there is an important point, of course, which is that there has been a very big shock to national income. National real income has gone down because of these very big what we call terms of trade shocks. Import prices have risen much faster than domestic prices, and that has reduced our national income as a whole. Now, the concern for us, we can't, I wish we could make that go away, but we can't. What we have to watch, of course, is what we call the second round effects, the domestic inflationary pressures coming through. That's why we raise interest rates. And it's looking at how those effects take place, how people form their expectations about future inflation that is so important for us. And that's the point. So the wording is critically important because I want to emphasize we are very sensitive to the impact that this has on people in this country, very sensitive.
I want to ask you one question about the banking crisis. It feels like it's moved to the background of people's minds, but there's still regional banks in the US. Issues are flaring up. Even today, we're seeing some of the banks there come under selling pressure. How do you think about it in the context of potential financial contagion to the UK banking system?
Well, we watch it very carefully, and be clear. I mean, as you said, it's had a bit of an ups and downs to it in terms of the news, but we watch it very carefully. We're watching very carefully for contagion effects. We're obviously heavily involved in the global discussions and processes. What I would say, and I'll maintain something I've said a number of times in recent weeks, is that the UK banking system, I think, is in good shape. It's robust. Its capital and liquidity positions are robust, and it's in a position to support credit supply to the economy, and that's very, very important.
Thank you.
You're welcome.